Hello, this is Susan McCord with the Augusta Chronicle, and today we're going to be live with a couple of expert financial planners. We have on the left Jeff Fehrman. He's a certified financial planner and president of Fehrman Investment Group, and on the right we have Troy Breitmann. He's a certified financial planner and senior trust advisor at Queensboro National Bank and Trust. And feel free to submit questions over Facebook and we can ask these guys, and we also have a few ready if y'all want to get started.
Sure, absolutely.
So we have a few days before the end of the 2018 calendar year. What are some of the common things you might advise individual clients to consider from a financial planning, tax, and trust perspective?
I think from just a planning perspective, a couple things to be thinking about here at year end, and some of which you can do into next year. So the next year or this year would be IRA contributions if you're eligible, Roth IRA contributions. Again, if you're eligible, depending on your earned income, those are things you want to check in with your CPA on. You can, of course, file those up until the time you file your tax return. So they're year end, but beginning of the year considerations. Certainly charitable gifting is something to think about. It's going to be hard pressed. We have a lot of clients that gift stock, so they gift appreciated stock, so it helps them tax-wise. That may be hard to get done before year-end, but certainly cash contributions, churches, not-for-profits, going to take those up until the 31st as well. That could help them tax-wise. You really need to check with your accountant from the tax help just because of the higher standardized deduction currently.
And I would mention on that in terms of taxes and charitable, you can now make distributions directly from your IRAs to a charity. So if you're in a situation where you have to take a required minimum distribution but you do not need that, obviously with a standard IRA, if you take the distribution that is a taxable event, you have to count that as taxable income. If you don't need the required minimum distribution but you're required to take it out, you can do a direct transfer to a charity. I believe that's $100,000. It's up to $100,000. That you do not get to take a charitable tax deduction for that, but you do get to satisfy your RMD requirement, and it is not a taxable event for you. So that's a very powerful tool for folks who do not need their RMD, and it's great for the charities as well. And
what's the tax implication? Is there any for the charities, Troy?
The tax implication for the charity?
Right, they don't have any implication because they're not for
No.
profit. Yep.
Yeah, if you were to leave an asset, that's a good point too. If you were to leave an IRA, a standard IRA as a gift through inheritance to an heir, and you have not taken out all your RMD, that is an asset that the heir has to pay income taxes on. It's called income in respect of a decedent. And so when that income comes out, it will be taxed at their tax rate. So if you're actually looking at two different assets, I have, let's say, stocks, and then I have the IRA, and I want to make a gift to the charity. So most people's initial thought is I'm going to give the stock to the charity. The IRA is actually a much better gift if you wanted to leave an estate gift, because then you never have to pay taxes on that income as it comes out.
For the viewer refreshment, what's the magic number on the RMD?
The RMD is $100,000.
And what's the age for the viewers?
You have to, you must start taking distributions. In classic IRS form, they make it overly complicated. It's the year after you turn 70 and a half. You have to start taking RMDs, and that sounds simple, but it's still not that easy to figure out. Well, let's just say 70 and a half, you have to start taking the RMDs.
Tax laws like the Financial Planner Full Employment Act.
That's right. That's right.
And so what about the self-employed or small business owner? Are there any special considerations or strategies he or she might want to pursue?
Yeah, those are things that I love as a planner because it gives you so many more options retirement plan wise, some of which are going to have year-end deadlines like a simple IRA for employer contributions. If they don't have one set up, that's not going to work till next year. But a simplified employee pension plan, a SEP, may work for them. Again, depends on their makeup of their company, and also depending on how many employees they have, a solo 401k is a good planning tool. Little nichey, depends on the makeup of your employees, but all of which are good planning tools. Keep in mind, I think people get confused sometimes. They worry about, oh, the market's off. Well, keep in mind those are tax rules. They're not necessarily an investment per se. It can be mutual funds or something, but it can be something as simple. If you're edgy about the market, put it in there and just use the cash account for now if you want to, Susan.
Well, I would say for the long range planning, if folks think about it on the personal side, they need to make sure that they've got all of their ducks in a row in terms of powers of attorney for advance directives for health care, your will, things of that nature. Sometimes, particularly in partnerships, that gets sort of put aside and not really addressed. So if you have a partnership or multiple partners in particular, make sure you've got an agreement in place that if one of the partners either dies prematurely or is unable to function in that role, what is the next step? Do you have insurance policies to compensate the partnership for the value of the work they bring? Do the other partners, do they buy that interest out? Does it pass along to another individual? Sometimes those are very big blind spots that partners forget to make arrangements for. They may or may not have done that in a personal life, but the business is very important as well. You have to consider, and what is that time period? If one of the functional partners, if they cannot carry out their role for a week, 2 weeks, a month, what is that time period? Is it 6 months? Is it a year where we can no longer function? And what is the plan at that point in time?
Good point.
Well, the fourth quarter has been particularly volatile for investors. Does this create any tax advantages or opportunities?
It could, so I would take a real hard look. We've done a lot of that this week. It's been busy, especially with one of the worst days of the year, Christmas Eve, and one of the best days of the year yesterday, or best days in history, actually. So some planning opportunities there would be tax loss sales. Well, we do a lot of year-end, and I'm sure Troy's group does as well, where we're basically, a lot of people say, well, I don't want to sell something because the market's off, which makes sense, long-term hold kind of strategy. So what we'll do is swap one asset for a similar asset, so if the market comes back, we catch the swing back up, but we get a tax loss sale, so it offsets any gains. I think there's going to be some individuals out there that have a big surprise that some of their mutual funds external to retirement accounts have declared gains even though they've lost money this year. That's one of those complicated tax implications for mutual funds, but it's going to be some surprises, I suspect, when they get to their CPA here in spring.
Yeah, I kind of dabble a little bit in the tax side of it. There's a concept called realized gains and unrealized gains. So when you're getting your statement and you've earned, your portfolio's up, let's just pick a number, $10,000, but you haven't actually sold any of those assets. That's an unrealized gain. That's not taxable. It's not a taxable event to you. If the market goes down, you've lost money or gained money on paper, but it's nothing that you can take advantage of tax-wise. You can't spend it. If an asset is sold with a gain, that is now a realized gain, that is now a taxable event. So the opposite is true, is if you sold it at a loss, that is a tax loss. So, and Jeff was referring to, is very important, and I think everybody needs to take a look at this, is to do this tax loss harvesting. Because if you do have some of these realized gains, you're going to have to pay tax. So if you can make a sale and go from an unrealized to a realized loss, you can offset some of those gains. So you take advantage of both the up and the down. Obviously, it has to be done with the help of a professional and make sure you're doing it in a smart way. You're not just dumping the gains
right.
and the losses until you get a zero. That may not be the best way to go. But it's important to differentiate between an unrealized and a realized, both gain and loss.
What special investment tax or trust considerations should consumers think about if they had a major life change in 2018, whether a birth, marriage, divorce, death in the family, retirement?
Yeah, that's a great point. I think that there's lots of reasons to change your investment portfolio. People kind of intuitively think that the major reason is economic, as we've seen this volatility and fall. Certainly that can be a time to rethink your risk profile and your allocation, but I find a lot of the changes that are made are not as economic driven as exactly what you're talking about of, hey, I'm close to retirement, so my strategy has changed. I've been in an accumulation strategy, now I'm in an income strategy. That typically looks fairly different from a mix of your investments. Certainly overlay the ups and downs we've had. If you're taking income, that has to be really a good strategy because you're exponentially decreasing your account if you're taking draws versus if you're in the accumulation stage. So any of those life status changes, a divorce typically changes your feelings, because a lot of spouses have different opinions of where they want to be risk-wise. So it may not even be your needs have changed, but the wife may be more conservative than the husband or vice versa. So all those things can drive fairly drastic changes in their portfolio.
Yeah, I always encourage folks. Everybody starts thinking about this time of year, their tax situation, charitable gifts. What am I going to do for 2019 or the coming year? And I always encourage folks to think a little bit deeper, right? So who sits around and thinks about their estate plan, their will? Do I need a trust? All of these type things, life insurance. Well, life events are a great time to do this, and this time of year is also a good motivator to do it, particularly if you've had a child or someone in your family has a child. So who are the people that think they need a will the least? It's usually young folks. I've got more debt than I have assets, so I'm a negative net worth, so I don't need a will. Well, that is completely the wrong answer. So if you have a child, the only way that you can name a guardian for that child, if a tragedy were to befall both parents, is through a will. So in my mind, that's one of the greatest needs and responsibilities. So if you've had a child, make sure you start thinking differently about your life. Make sure you get that will in place. Life insurance is now a critical need. So particularly if you have two young folks both working, what is the economic value to each other? Probably not that great, because they're both earning income. But well, now you've got a child you've got to raise for 18 years. So what if you now no longer have the ability to bring that income in due to a premature death? So life insurance is critically important if you have a child as well. Other less happy events, deaths, divorces. This is a time to be thinking about. We talked about life insurance. We talked about wills. You can name folks you want to take care of. Well, beneficiary designations. We talked about IRAs a little bit earlier. Beneficiary designations trump all other planning. So if your will leaves all of your assets to your wife, but you've had a divorce, you've got a new wife, and you pass away, well, it follows your wife. So, but now your beneficiary designation does not automatically do that. It's by name. So if you have a previous spouse by name in that beneficiary designation, guess who gets the asset?
The new wife's not going to be happy about that.
Not going to be happy about that at all. There may be another death for the day. But it's very important. And if you have children and now they've gone on, their age of majority, they've graduated college, they've got a very good job, maybe you want to change that. So make sure that you're pulling out your IRA, your life insurance, qualified plans, 401ks, all of these designations for beneficiaries. Make sure that you just touch base with that every now and then. And major life changes are a great opportunity to do that.
So when looking forward to 2019, what should people's expectations be from an investment and tax standpoint?
I think you're going to get more of the same. That's the magic crystal ball, right? I think you get more of the same from the standpoint of volatility probably continues to be at increased levels compared to historical norms. Part of the problem is 2017 was a great year for the market, as well as it was a great year from the standpoint of it was historic low volatility. So we've come off of a year prior to this year that was historically low. The other were more than historically high, so it probably feels worse than it even should. But I think you're going to have to be prepared if you're an investor for some bigger swings this year. There's reasons for that. We're hopeful from our Raymond James standpoint, who we use research from, has a base case of probably double-digit returns potentially on the market, barring the big, I guess, things that are making the market volatile, which is the China tariffs concern, the government shutdown, probably less than the China situation. And then the interest rate increases. Market's worried about rates go up too quickly, and that hurts the market in a big way. So some of those things could resolve themselves and we get some really good lift. The good news is we still have historic low unemployment here in Augusta. I just heard a number this morning. I think we were 0.3 lower than last month, which is great. So we have good things going locally. Also, interest rates relatively are historically low. So there's still some good news out there. The press just likes to play up some of the bad stuff. It's more exciting, I guess. So
I would just say in a, almost to your point, more of a normal, or at least approaching more normal volatility, where we just have not experienced that in a very long time. I would say it's more important than you're just working with your advisors, making sure that you're not really looking to hit the highs and lows in timing. It's never been possible, never will be possible in my opinion. So now it's more important than ever that you've got a good overall plan. Your allocation, as you mentioned earlier, are you getting closer to retirement? Make those changes. Be in the proper allocation. Rather than chasing the return, chasing the number, make sure that you've got the right plan for your time in life. Do you have 20, 30 years of retirement? Do you have 10 years? Do you need the income? Are you looking to accumulate? So though the bigger questions are more important to get your arms around, and then make sure you have a plan that allocates the risk appropriately rather than trying to hit which Thursday afternoon in 2019 is going to be the buy or the sell opportunity. And one other thing occurred to me when I was talking about major life changes, and this is something I've just gone through, and it's easy to forget. If you have children who have graduated and are off to college, we all know this in our minds, but it's always a shock when you find out. So you're sitting there at the orientation, and the registrar and the dean for academics is telling you, look, don't call and ask for grades because we can't give those to you. Wait a minute, I'm paying the bills. I want to know what's going on. Well, your child is now an adult, and so in order to get that information, they have to provide you permission to get grades, to get all that. They'll cash your checks just fine, but you have to make sure you've got things in place. So power of attorneys, we think about power of attorneys for maybe aging parents or for ourselves if we're not able to make those decisions. Power of attorney for your child who might be 18, 19, 20, who's off at school. If something happens and you need to step in and conduct some business on their behalf, if you do not have that legal authority, it's going to be a problem. So not saying it won't be done, but it's going to be a lot more time consuming, a lot more difficult, and it's just a good thing to have in place. Now, obviously, you need to have a talk with your child because they need to make that decision as well. But it's something that it's easy to overlook, and,
absolutely.
and it's something that.
I mean, you're talking about just a blanket power of attorney over your.
Well, the interesting about power of attorney, and I'm not an attorney, certainly don't want to give any legal advice in any way, but power of attorneys can be very specific, or they can be very broad. So you have to find what works best for your situation.
I would say generally kids it's going to be more wider net, if you will, just because you want to be able to, just like with a spouse or somebody like that.
Right.
We just did the same thing. My daughter's at University of Georgia, and we were redoing all our wills because we have guardians, and that's all irrelevant because she's 19 years old. And
that's right.
I said, hey, don't we need a power of attorney for the same reason that, God forbid, you hate to think about those things, but we've both seen some train wrecks, not as much with kids, but aging parents.
Sure.
It's one of the least expensive planning tools that can make the biggest impact. It's not a huge cost is the great part about it. We're not talking thousands of dollars, you're talking hundreds of dollars. So.
Yeah, there's no question.
Yeah. And go to somebody that is a good estate person, not some nonsense off the internet. That's just, we don't have any skin in that game either, by the way. But the wrong thing could be worse than having, nothing, I guess, sometimes. So.
And things are, it's hard to tease out. It was close, but close doesn't count in the right situation.
Right.
We almost got it right. So, get some help that you can get the exact right thing that you need. And all of these things we're talking about, this is a good time of year to consolidate. So you might know exactly what's going on. You might have a handle on it, but does anyone else? If anyone else would need to step in, even for a temporary time period, could they do it? Where's your stuff? Where do you have them? The most basic things. Do you know where all the bank accounts and credit cards are? Do you know where these things are? Where's a copy of the will? Where is a copy of, who's the investment advisor? If I need to pick up the phone and give it, make sure that everybody has an access to that you want to have access to that. And we're on Facebook Live now, so here's another good point that we don't see much of now, but I think you're going to have to see more of this in the future. What are your passwords? How does somebody access not only your brokerage account, your bank account, but your social media accounts and other things? Because without those passwords, those are very difficult to get. And don't put this stuff everywhere, but identify people, some key folks that you want to name. Make sure you have that conversation. Hey, look, if something happens, here's the roadmap and how to access it. Maybe give them a copy for their safe deposit box or what have you. So.
I think it's a great idea, and we like to advocate, have a hard copy because most attorneys will make you a good little book. You've seen them. And we always recommend and really push hard to say, hey, send us copies of those actual documents that are copies of originals, and we keep it in something called the vault, which is basically electronic copy. So the house burns down and mom and dad pass away, we've got an actual copy. And sometimes people are reticent to say, oh, I want to give all these documents to my kids. Well, they may not. If you don't want them to, you don't have to give them all that information. They just need to know where to go
How to
get
access
it.
it.
Exactly,
How to access it,
exactly.
yeah.
Because everybody has different feelings on privacy, which is understandable. Yeah.
Well, my last question was pretty much about long-term planning. I think we have addressed
Yeah.
that.
Yeah.
Anything else you want to add about that, or any other points that we haven't made today that you want to add?
Any parting words of wisdom from you?
No, I think I appreciate the opportunity to have this type of conversation, because that's something I push a lot. Make sure you're integrating in.
Mhm.
It's not like you've got your long-term legacy estate, what have you, over here. I'm gonna take care of everything. At some point in time, I'll worry about this. Well, when is that? Is it a birthday? Well, we've all lived long enough. We know it has nothing to do with how old you are, what your situation is, rich, poor, somewhere in between. Everybody needs to think about it. And rather than have it set over here aside, at some point in time I'll think about it, just bring it out, integrate it into your annual, semi-annual, however often you think about this. Bring it out as you're thinking about your retirement accounts and your investments and your taxes. How do I make this part of it? You know, your designations, what changed in a year, are we covered? So I appreciate to be able to have this type of conversation, to bring that out and make it part of the everyday conversation, because that's the way we avoid the pain of missing something.
That's right.
And it could be a very painful situation. The only other thing I would say, most people for having their mind that in their planning, I've got to do something because I don't want the government to get all my money. I'm going to I'm going to die and I'm going to get all my money. Well, and if you've been in a situation where you've had planning with trust or estates, charitable gifting comes into this, where let's just get things out of my estate so I don't get taxed on it. Well, the law changed a couple of years ago. It's now, they just announced the numbers for 2019. It's 11.4 million, so nearly $11.5 million every individual can leave to anyone they wish without a estate tax. You combine that, it's nearly $23 million. So I think I read a statistic the other day. It's right around 1,800 estates last year were actually taxable in the entire United States.
Yeah.
So
It's not your average person.
it's not the average person, that's right. So if you have any type of plan, and in the past you have set aside things, trust or other things that are outside of your estate, sit down and talk with your advisor, talk with your CPA, your attorney. How do you get those things back? Because there's this concept called a step up in cost basis, and it doesn't matter how much money you have, everyone will be affected by this some point in time. Mom and dad bought a house 60, 70 years ago. They lived in it their entire life, and you'll see this sometimes. Well, I just want to give it to my kid. I want to give it to my child now because I feel good. I want them to have it. They actually inherit that cost basis for that house, what they paid 60, 70 years ago. So at some point, if they sold that house, they have to pay tax on all that gain. If they left the house to them through their estate, the value gets reset at the value of the date of death. So now that child has no gain in that house. So it's an asset to them that if they needed to sell it fairly quickly, there would be no tax on the gain. So that's just another little tidbit that I don't think we really touched on. And most people think, wow, that's for really rich folks.
Yeah.
No, particularly real estate. If
Most
there's a home or
people
yeah.
own a house. That's right.
And very few, and we see this all the time. Well, I want the kids to have a piece of the farm, or I want the kids to do this, and it's great. I think it's fantastic, and I don't think you should ever let the tax tail wag the dog. But hey, do we really need to do that? Because sometimes if you've got, say, a farm, it might have been in the family for generations, you might have next to nothing in terms of cost basis, and it might be very valuable now. So
Yeah, I would say that a couple things, kind of just thinking through what we all talked about, that I would think about is two things really. One is the planning component of that. I think there's a decent amount of planners out there that do what Troy and I do, that do a pretty good job on the front end. But if I've seen one thing I see missed is the monitoring aspect. That, you know, when you hire an advisor, how are they going to monitor, kind of go back through, like Troy was saying, of once a year, twice a year, depending on, you know, how complex it is. How often are we going to do that? And then also, if you're looking, a lot of people start thinking, especially when it's volatile, if you're interviewing somebody or you're retired and haven't had an advisor, make sure that advisor works as a team with the CPA and the trust people. And that's one of the ways I pick other professionals when I'm working with an attorney and CPAs, is I want those people to feel good about working on a team and not we're just going to go over here and do our own thing, because everything we all do is so integrated. So you need an advisor that really is quarterbacking and bringing in other experts, I guess would be and ask them that question. How do you do that? How do you pick your other advisors? I mean, they should be able to articulate that for you. So
sort of like everything I needed to know, I learned in kindergarten. Make sure folks you deal with play well with others.
yeah, it's a good point.
It's
Team player.
In an increasingly complicated world, it's hard to be all things to all people.
Agreed.
All right, well, great. We have been live today with Jeff Fehrman. He's a certified financial planner with Fehrman Investment Group, and Troy Breitmann. He's also a certified financial planner, and he is senior trust advisor at Queensboro National Bank and Trust. And they've been talking about year-end financial planning and taxes. And thank you very much, guys, and
Great to be
thanks
here.
Facebook viewers for watching. And we're gonna sign off now.